Welcome back, everyone, to another episode of Ready, Aim, Retire. I am Rob Kirvan, founder of Advanced Planning Advisors Group, a company where we focus on your retirement plans, your legacy plans, and kind of everything in between. And today, I'm not going to introduce him yet, but we talked about this last week, Tony, that we had a big get today, didn't we?
You got a huge get. I don't know how you get these people to come on your show, especially the A-listers.
And I'm going to tell you, like, this one's so hard to get that he was supposed to be here, I think, last week, and he was in like Ohio speaking at something. So we had to postpone it.
Yeah.
So we're grateful. And what I want to do is I want to welcome Jeremy Bryan from Gradient Investments. Jeremy, welcome. Thank you for slicing out some time for us today.
Look at this. Wow. I am just
welcome.
The head is just inflated. Oh, there it just exploded. I was gonna say the ego was going higher and higher every minute here.
We try to build it up here. We want to keep people captive, Jeremy.
I love it.
Listening. We want to be clicking off already. So that's how you been, Jeremy.
I am doing well, sir. Thank you for having me on. This is awesome. I appreciate it. So I'm happy to be here, and I'm here to answer any questions you have. So you set them up, I knock them down. That's the way we're going to do this today.
And I have a bunch, and hopefully we get to them all. But we don't want to run this thing like an hour and a half, because I could talk to you for probably easily that. But first of all, tell us about yourself. Like before Gradient and post Gradient, while you're there, what have you done and what do you do now?
Yeah. So I've been an investment geek for my whole career. Oh, there it is. Look at this.
Tony's on fire today.
Tony found Tony. Yeah, Tony, did you get a new set of buttons? It's okay. I got it. No, but I did have about 20 cups of coffee before the show while I was waiting for you to come up.
It shows.
Nice. So I've been doing this about 25 years now. So before Gradient, I was at hedge funds, primarily kind of quote unquote grew up in hedge funds. So I was in Minneapolis and New York for a few years, doing that investment analysis, idea generation for that kind of stuff. So then I came to Gradient because I honestly wanted to work a little bit more closer to the actual end client. When you're at a hedge fund, you're basically behind the screen all day, not doing anything. You're just trying to figure out what the next investment is, and that's it. Mm-hmm. I wanted to get a little bit more interactive and talk to the people that I was investing with, and that's why Gradient was so intriguing to me. It's from the side of owning that relationship and being a part of this kind of stuff and working with you and other advisors that we work with in saying, how do we solve plans and problems for clients? I think that was more interesting to me. Right. And it's really kind of, my side is to be much more the put it to work, right? You're going to know your clients way better than I ever will. But my job is to put that plan to work for you. And that's what really brought me here, and been doing it now for 8 years. Really excited, really happy, love it here, and enjoying my time.
And I'm sure like 8 years is great. So I'm sure 10 years, what is Gradient? They give you like a Rolex, Ferrari. Like how does that work when you get to the 10-year mark?
Yeah, but they're Hot Wheels.
They're Hot Wheels. I knew there was something there. I didn't know what
the Ferrari rolls in, but they do this. They just roll it across the
Rolex is at 20 years and it's a knockoff.
No. 2 L's in Rolex.
Yeah.
The hands spinning the wrong
Rolex,
way.
it's ECKS.
Yes, there you go.
Yeah.
And so Jeremy, you're up in Minneapolis, obviously, because you're working there. You work at this, with Gradient every day. You're not remote. You're working in there with the people, right?
Yep, we're in the trenches. So I manage the investment team on for us, and we manage about $6.5 billion now. So my team is always together because there's always something going on in the markets, right? There's always something to talk about. There's always something to understand. There's always actions to take. We take, when necessary. Right. So from our side, that's really, my team, we don't honestly have any offices. We sit in a big open area because there's always, we're always bouncing ideas off of each other. And so it's the easiest way for us to do that is to kind of keep the open environment and kind of keep that collaboration going so that my team is all cohesive across the board. Because what we always say is a good idea might not be a good idea for one portfolio, but it might be a good idea for somebody else's. So you want to know what's going on.
Right. So when you're analyzing companies and looking at things, what you're kind of saying is, you guys have a wide suite of different portfolios and strategies. So sometimes it may fit in A, and sometimes it may fit in B. But if we like the company, maybe we're trying to find a spot for it.
Yeah. And usually what it ends up being is, hey, this isn't a good opportunity right now. Let's put it to aside, but it brings up 3 or 4 other ideas that you may be looking at because you're looking at competitors, you're looking at the industry as a whole. It may give you another avenue to take for a completely different portfolio, because all of our portfolios are objective focused, right? There's an objective in mind. And so if it doesn't fit that one, maybe it fits another one. And so that's why we want to keep it open. And we do, I still do this, and my whole team does it, is that anytime we're analyzing something, we do a written analysis on it and we send it to everybody in the group, because we want to try to get leverage off of that research. Even if it doesn't lead to a trade, we're okay with that.
Right. Oh, that's fantastic. That's fantastic. The whole collaboration, I think, is key, right? So you don't have just one chief saying this is the way we're going. Everybody's kind of helping out with the decision making.
Yeah, I like to think we hire smart people that do good work, and so we want to leverage that across everyone. And
does Jonathan Van Orden though still work for?
Yeah.
Oh, you just said you hire smart people.
I'm one of the smartest.
Oh, Tony coming in with a dig.
All right, I know, guy's not even here to defend him.
This is not my opinion. It's not the opinion of the Ready Aim Retire.
No, I'm teasing. I happen to know the team very well, and I love them. I love JVO and Keith Gangle.
Yeah,
I mean, he's not much to look at, but a smart guy. I mean, really sharp. So,
well, Jeremy, before we go to the next question, you want to get Tony another coffee?
Yeah, I think we need to go the other way.
Is it watering them down?
A sedative. Yeah.
Okay, so let's talk about some of the portfolios you manage with Gradient. So I've picked 2, and if there's other ones, feel free. But the first one I'm going to pick on is the G50. So the G50, and you can elaborate what it is, but I'm just going to start off by saying it had a slow start this year.
Yeah,
and it seems like it's really been taken off. So why don't you explain to our listeners, what is a G50? What's the theory behind it, or the method behind it, and kind of where it's at and where do you think it's going?
Yeah. I'll start with what it is.
Yes.
So the G50 is what we call a high quality dividend paying portfolio. So really all that means is it's 50 stocks, because we're marketing geniuses here. G50, 50 stocks.
Okay, makes sense.
Equally weighted. And so what we're looking for there is good U.S. companies that pay a recurring dividend, and hopefully a growing dividend over time, because we want 2 things from that portfolio. We want long-term appreciation. We want the stocks to go up, right? But secondarily, we want to get that income. We want to get that dividend stream that we feel that will not only, it supplements the income that our retirees are getting, but hopefully, and if I do my job correctly, this actually happens, is that good companies tend to grow their dividends over time, right? So what you'll do is you'll be able to get more payments down the line to offset the effects of inflation. So that's really what that portfolio is designed for. So if you think about that portfolio as compared to the markets, it's pretty different, right? In the effect of, 1, it's going to own 50 stocks that are equally weighted. So everything is 2% basically.
Yep.
2, has to pay a dividend. The company that it invests in there has to pay a dividend. And then 3, we're looking for that, again, that US, I really kind of call it a names, right? Is that when I give people that list of the 50 names, and I'm happy to do it, 48 or 49 of the companies you're going to look at and be like, oh yeah, I know what they do right away.
Sure.
And they get it. Sure. They understand it because it's been around a long time. It's one of those stalwart companies that we feel will be around in the future. So that's really what we're trying to build with that portfolio. We're trying to also maintain diversification, right? I don't want to own 50 utility companies. I don't want to own 50, consumer companies. I want to own a mixture of a lot of different things. And so, as you said before, that, the slow start, if you will, compared to the markets, and I'll be completely honest, I'm going to take this a year back, is that 2023 it underperformed the market significantly.
Right.
Because what happened? The overall market was really driven by about 7 stocks, right? The Magnificent 7, as they're called. That was your Amazons, your Microsofts, your Teslas, your Netflixes, those kind of stocks, right? Phenomenal names. Don't get me wrong. We own them in other portfolios. We don't own them in the G50. And the reason for that, none of them pay a dividend, or none of them have the yield that we would consider buying for this particular portfolio.
Like it's a minimum yield or whatever you're looking for.
Exactly. So it just didn't fit the criteria. And so under those circumstances, and those were driving most of the returns of the markets in 2023, the G50 just didn't keep up. The average stock did not perform like those 7 did. So it was a very different performance during that period of time. We were up 10% last year, which isn't terrible, but it wasn't the 20+% that we got from the S&P 500. Turning to this year, that same kind of thing was happening, right? As the early part of the year, we were starting to see, those same 7 stocks were working well. Dividend paying stocks were working okay, but not quite as well. What we've seen here recently and why the portfolio has started to see a little bit better performance is frankly interest rates coming down. That has a pretty big influence on dividend paying stocks. And the reason for that is, again, when you're looking for income, right? When you're saying, I want income, I will look to if interest rates are high, you can get most of that from fixed income, right? In those areas, bonds, basically, right? Bonds and other assets that pay recurring income. When interest rates are high, dividend income doesn't look quite as good, right? Because it's not going to go up like interest rates do during that period of time. So it's not going to pay the same level of income. But as those have come down here recently, and as the expectations of rates coming down in the future, I think that's the bigger thing. People start to look again towards those dividend paying stocks and saying, well, I'm not getting as much from my bonds anymore, or it's done pretty well. I want to diversify, but I don't know if I want to go chasing that, those Mag 7 stocks that have worked incredibly well and are now kind of expensive. Maybe I'll buy some of this dividend oriented stocks to get that recurring income stream that looks a little more attractive. And also, frankly, the valuations are a little cheaper than those other stocks.
Because they were left for dead, right? So the
yeah. I mean, it's not like they fell apart, but certainly they weren't going to the extent that, that the other companies and especially those growth kind of AI oriented companies, right? So we're not, the G50 is just not going to play in that field as much because frankly, most companies don't start paying a dividend until later in their maturity cycle when they're a little bit more recurring, a little bit slower growth, which that's fine. Over longer periods of time, these companies are still going to grow. They're still going to grow their earnings. They're still going to grow those dividends. That's the kind of stuff we're investing in. And we stick to that knitting, even if that type of investing is out of favor temporarily, because again, we have multiple portfolios. We can do a lot of different things.
Right.
But for me to change the knitting of that portfolio is inconsistent with what I've told my investors. And so that's why we'll just never do it.
Well, and I like the fact, if I could jump in, dividend paying stocks, I love talking about dividends. And I like how you pointed out that a dividend paying stock is a way to at least help keep up with inflation.
Yeah.
Because not only are you making, your return on that investment, you're also getting that dividend.
Yeah.
And that dividend can go right back in. So you're consistently dollar cost averaging and putting more in, and it's helping you keep up with inflation.
Yeah.
I really like that. And that's why the G50 has been popular, because you only use dividend paying stocks.
Yeah. And especially for the client base that we tend to work most with, which is near or in retirement. Right. They want that recurring payment stream, right? They have expenses. They're kind of in distribution mode rather than pure accumulation, right?
Sure.
They still want to grow because they still have to offset inflation because they're going to live with that money for 20, 30, hopefully 40 years, right? So they still need to grow, but they also want that recurring payment stream. Yeah. So that's why the G50 has been pretty good for especially for our client base.
Yeah. And on the flip side too is yes, it underperformed last year, but it's still, like you said, it still did 10%. 10% is good. But in 2022, when those high flyers that we speak of, like everyone loves, Google and everyone loves Amazon until they don't. And when you see them in 2022 or a Tesla, where they are getting clipped and more clipped, I think that G50 was only down like 8%. And I think the market was 20 plus, right?
Nailed it, sir. That's exactly what it was. Yeah, we were, so we were down 8 in 2022 when the market was down 20. And we expect that to actually, will it be that level? Who knows? But we do expect, because of the companies we're buying in there, they tend to be a little bit more defensive, right? They tend to be I don't want to say the last thing sold, but they tend to be lower on the priority list of being sold because of that dividend. Gives them some security. Secondarily, these companies have been around for 50 years and they're most people think they're going to be around for another 50, right? So they tend to kind of lean on those things a little bit more when things are starting to fall apart a little bit in the market. So there is some defensive quality to that characteristic. And frankly, that's what we look for when we're investing in those companies is, hey, who's going to hold up? Who's going to weather the storm? Who's not purely levered to just what's happening in the markets right now? What is going on in their businesses that allow them to continue to grow even if the markets have a little sketchy time frame?
Right. So the bottom line is we're buying high quality companies that have a dividend, can increase the dividend, hopefully. And they're a value of nature. They're not, we're not chasing growth stuff. We're not chasing AI stuff. We're looking at fundamentals of companies and saying, long term, we like this. And this should, be a good addition to the portfolio.
That's exactly right. And it doesn't have to be the whole part about the portfolio, right? Is that there's plenty of room for having your Amazons and your Metas of the world, right? Fine companies. I have zero problem with them as companies. We own them in other portfolios. Just doesn't fit the criteria of this one. So, and that's fine. And this is for a different subset of investors. So you can use this as part of your overall relationship of what you own in the market. And this is that portion that, hey, hopefully holds up a little better during times of decline and also just gives you that consistent recurring dividend income.
And it also shows up in, you guys, we're not going to talk about it today, but there's a tilt portfolio where the G50 finds its way into there. And depending, I'm sure, of market conditions, the percentage that we hold in there goes up and down. We have several clients with the tilt portfolio because I just love that strategy. But we're not going to hit it today, but you're right. They fall, it can still be part of your whole plan. It doesn't have to be your whole plan.
Exactly. And then that always comes to the individual investor, right? This is where the customization and the tailoring comes into play. So we have 30 different strategies, right? Is that this can be a part of, or it can be a significant part of, depending on what that investor is looking for. Again, the objective of the investor leads you to where the portfolio is. It shouldn't actually be the other way around. It should be, what is your situation and what is best for your situation? And we have solutions that fit almost every investor from conservative to ultra growth.
Perfect. Let's talk next, Jeremy. We'll hit on the buffered index. What is the buffered index? Now, so Prelude, we have several clients that have that are in the buffered index, but I'd like Jeremy to kind of walk us through, because there's several that aren't, and there's a lot of listeners out here that would have no idea that this strategy actually exists out there.
Yeah. And it sometimes surprises me, but you're absolutely right. Because it is, again, going back to who we work with. Let's start there again, is that we work with people mostly near or in retirement, right? And so they want growth, but they want protection, especially at the early part of retirement, right? Is that, the sequence of return risk. We talk about it all the time, right? Is that early declines can have a really significant impact on what you do in your retirement. So there's a level of protection that people want once they make that, or if they're thinking about or are in that transitional period. So from a buffered index component, it fits perfectly for that, because it provides a level of downside protection and a level of upside participation. And I'll get into those here in a minute. So the buffer component is the level of protection. And the nice part about it is we issue about 5 to 6 of these per month. So there's always some different things going on. But from the side of that is you can pick your level of protection that you want. If you want a little bit more chance for a little bit more upside, you take a little bit less protection, like let's say 15%, right? So if the market in the next year or 2 years is down 12%, you don't lose anything from that asset. You have
because you have this buffer
protection
built into it.
You have that buffered protection, right? And we can go all the way up to 100% principal protection, right? And so the market's down, you don't lose anything. From that side, what you're doing is then how you quote unquote pay for that protection is by giving up some of the upside of the markets going forward. But it's a lot less than you think. So, we have current offerings right now that have 100% principal protection for the next 18 months.
Okay.
And that has a cap of performance, which is your maximum of performance you could achieve, of 12.5%. So in the next 18 months, if the markets are up 10%, you're going to get 10. If the markets are up 12, you're going to get 12. Now, if the markets are up 25, you are capped out at 12+%, 12.5%. So that is the capped component of it.
Okay.
But again, going back to who we're doing this for, I think that's always the more important thing is, again, that's 100% principal protection to avoid that sequence of return risk that comes as a result. And then if the upside goes, you're still achieving upside levels. You're just capping it out at a certain level. And most people, over the next 18 months, especially for getting 100% downside protection,
Right.
would be okay with getting 12.5% over the next 18 months.
It's
That's
8%
what
a year.
Yeah, exactly. And it works out pretty well for that. The other side, though, some people, 12.5, I think the markets are going to do better than that. That's
Yeah.
fine. Okay. We have a 15% protection that has uncapped upside currently. So whatever
What
the
does that
market
mean?
has, you participate in it fully. So if the market's up 25, you get 25. If the market's up 50, you're going to get 50, and you have 15% protection. So what happens there is, obviously a little different than 100% protected in the effect of if markets are down 10, you don't lose anything.
Right.
If the markets are down 20, you're beyond that protection and you start to experience loss, but you have 15% of protection first. So if the market's down 20, you're down 5.
Wow.
So we really consider these, again, kind of a win-win proposition, especially for our client base who is saying, I'm okay with giving up some of the upside. I'm okay with, holding this for 1 to 2 years kind of thing. And then secondarily, what I really want is that level of protection. And so these fit really well along with the rest of the plan that we're doing, right? Whether that's a component of annuity, some bonds, some growth stocks, we're going to mix those in. This also really fits in as a good hybrid in saying there's some level of protection, but there's also some upside participation if markets continue to rally.
And that's, you think about it. So everybody, it's like have your cake and eat it too. So the one you just explained. So I have a 15% downside protection. So everybody wants to get whatever the market does, right? But they just don't want the risk.
Right.
And that's, when I sit with clients, that's the conversation all the time. Well, the market's up 20. I'm only up 15. Well, the way your account is allocated, you couldn't possibly be up 20 because you got bonds and these other things, right? And what this kind of does is says, okay, listen, if you want to take some risk in the market, but instead of taking it in a growth portfolio for whatever the S&P or the Dow is going to do, how about you put it into this? We'll give you all the upside. So if it hits the cover off the ball, great. But if it doesn't and it goes the other way on it, you have this 15% protection. So that does sound like you can have your cake and eat it too, as far as I'm concerned. Like you like, especially in 2022, like market's down, 20+%. If I had one of these, all right, I'm down 5%. I'm not loving life. But on the other side, the other portfolios, and we managed they were down 20%, so you're not digging out of that hole either with that allocation. And that being said, is this, these are all allocations, Jeremy's talking about as far as a well-rounded portfolio. You could have a bit of G50, you could have a bit of buffer, you could have a bit of growth, and they all kind of come together. It's not an all or one, shot, but definitely just a great, portfolio for someone to have, inside of their overall picture.
Yeah. The component of protection too, that, especially in 2022 really shined. Because what do you usually use, under let's say a traditional 60-40, right? A 60-40 allocation, which most people, if you're a balanced investor, 60% stocks, 40% bonds.
Mm-hmm.
In 2022, that 40% bonds that was there to protect you, to provide some income. Well, we were in a near zero interest rate environment, and then interest rates shot up. So when interest rates go up, bond prices go down. So you didn't get a level of protection in 2022 from your bond portfolio. Those were down 8, 9, 10, almost 12% that year.
Right.
So in this is another arrow in the quiver that doesn't take interest rate risk with regard to that component and saying, well, if interest rates shoot up, I'm not going to have this level of protection. I'm going to be down significantly. So it's a different form of protection that you can use in conjunction with the other stuff. You can still have a 60-40 type allocation, just using this to provide a different level of protection for you as well. So I really think that for most investors, it does fit some level of criteria. Now, again, this isn't the entirety of their portfolio.
No.
We don't even recommend that.
Right.
But for a component of it and saying, I want to have some level of protection, but I want this thing to grow, we think it fits really, really well.
But what about people, Jeremy, who say that sounds too good to be true, the buffered index portfolio, where you get the downside protection and you get to participate on the upside.
Yeah, I think the biggest, I get that actually a lot, is how are,
because you
I
say it's a
usually
win-win. Okay, what's the catch?
Yep, because
right?
there's a couple of things. So
Yeah.
we issue these with investment banks, right? And they're some of the biggest banks in the world: Goldman Sachs, JP Morgan, Morgan Stanley, right? These kinds of things. So a lot of the feedback I get, or the negative, when people are looking for the negatives of this, is, well, clearly the bank thinks this, and so that's why they're offering me that, right? Is because I'm still going to lose because they think they're betting against me. And I always tell people, no, they're not. They're really, all they really want to do is they're getting a fee for the structure. That's really all they do. They build the structure, they hedge off all the risk, and they say, here's what you get using options. And we don't own the options. We own a contract with an issuer. So as long as that issuer pays their bills, and that's why we go with the biggest of the big.
The A-listed companies.
Yes, because you want to be sure that company is going to be around for a while, right?
Yeah.
Because you're going to have a 1 and 2 year contract with them, and sometimes even up to 5-year contract with them. So you want to be sure that they're there to pay their bills. That's the risk you take, right? Is that Goldman Sachs or JP Morgan aren't going to pay their bills. And if you're not comfortable with that, I understand. And then this is probably not for you. That's absolutely okay. But from that side, they are not betting against you.
Right.
And then secondarily, again, this is just basically a structure that is built that says, as long as this happens at maturity, you'll get this predefined outcome, whether that's that 15% protection or that, 20, 30, 40% upside to a cap, whatever that may be. So the other component of that I tell people is you want to hold this to maturity, because let's just say, for example, that first day you bought it, second day comes out, market goes down 10%. Well, you're not going to be fully protected during that period of time if you tried to sell it at that time.
Right.
So we always tell people, we're in this for up until maturity. Only use the assets that you can hold through the entire period of time. If you feel like, hey, I might need this in 3 to 6 months because I'm going to buy a boat, this is not for you. And that's okay too. That we have a lot of other portfolios that are going to be suitable for you for that. But we want you to be able to stay the course, because at maturity is the only time you get that level of protection and participation that was listed at the outset.
So really, besides the time, if you have, besides the money being tied up for a year or 2 or 3, there really, it really is a win-win. It's a great product, that buffered index portfolio. Then,
yeah, we've honestly called it a win-win-win in a lot of instances, because we have something, and Rob, you know about this one, but I want to talk to your people about the dual directional, right?
Sure. Yeah.
Because there's a component of a dual directional that's a little different. That this is where people go, how can you do this?
Right.
Because a dual directional is exactly what we talked about before, as a predefined level of protection. Let's say 15%, right? So if the market's down 20, you're going to be down 5. And again, it has that upside up to a cap. So let's say it's 50% to the cap. So if the market's up 30%, you get 30%. If the market's up 60, well, you're capped out at 50.
Okay.
Where the dual directional is different is what I call within that buffer zone. So that 0 to minus 15%. So within there, if the market ends up in that buffer zone, so let's say minus 5, you get the inverse or the opposite of that return. So if the market is down 5, you get up 5. If the market is down 12, you get up 12. Now, where it flips is beyond that buffer zone. So if the market is down 16, that is beyond the buffer zone, and you would lose 1.
Right.
But it really allows investors to think about that from a perspective of saying anywhere between minus 15% to 50%, or unlimited upside, to be honest with you, you're going to make money. That is going to work that way. So usually what I get asked is, why would you ever issue a traditional one that doesn't do this dual directional part, right? It's because the caps will be lower on those things. If everything else were equal, the caps would be a little bit lower on the dual directional, because you have chance to make money when,
and you have that extra feature, right? You have that extra feature, so you have to weigh out that
a little bit for the extra feature. But a lot of people love that in saying, oh, even if the markets are negative, I can make money. Yes, you absolutely can.
Yeah, that one is and you're right. That one is it's too good to be true. Like I've explained that personally to several clients, and I don't think I have too many in it, only because they literally believe it's too good to be true.
What's the catch I get all the time?
Yeah,
and I totally get it.
Yeah, and they don't understand that these investment banks, the reason they are who they are is because they make money on every transaction. So they wouldn't do it if they didn't have a way to make money inside of it. So when they build these out, they have a predetermined, they know exactly what they're making from day one, and they're done. And that goes in their filing cabinet and they move on to the next one, you know,
That's exactly right. They are
um,
not making a forecast of what the market's going to
no.
do to make money. They are getting a fee for putting the structure together for
Yeah,
it.
and they hedge both sides. It's almost like a bookie. They hedge both sides and they take like a little bit of meat in the middle.
I don't think they would agree with you, but but the analogy is absolutely correct.
That analogy's right. Okay.
Well, and here's the deal. But here's the deal.
Yeah.
The reason they're doing it is because they want your money, and the competition to get people's money has gotten so broad.
Sure.
With investments and strategies and annuities. A bank, Goldman Sachs or the bank, JP Morgan, they're competing with everybody. Everybody's competing to try to get you to leave your money with them as long as humanly possible, right?
Yeah.
If you have $1 million, they want to have access to that $1 million for a 2-year period, and they're willing to do whatever the market will bear or whatever they can handle to get that. And it's gotten so competitive that these deals have gotten better and better. We didn't see a dual directional 10, 20 years ago.
No. And the nice part about that competition that you mentioned is we kind of use that, right? Is from our side.
Use it for your clients. You say, hey,
exactly.
Look at what this guy's offering.
Yeah,
it's even better.
Well, and even that is that when we go out for these offers, again, we do 5 to 6 per month, is that we go out to all of them. So we go out to 9 or 10 different investment banks at this right now and say, give us your best price, because they know, JP Morgan knows they're competing against Morgan Stanley. Morgan Stanley is competing against Goldman Sachs. So if they don't compete and they don't give you the best offer, guess what? They don't get the business. And they all know that. And so that's where we can add some value there too, is that we leverage those relationships and we know those people directly. We take with them all the time. We're able to get better pricing as a result of that kind of competition that is out there, that, hey, we're going to look at these deals across the board. I mean, if you were taking too much fee, your cap is going to be lower. You're just not going to get the business. And
it's not like that money is sitting in a vault somewhere just getting dust.
Nope.
That you're giving them if you put $100,000 into the dual directional or whatever it is, or 500,000. It's not sitting dust. They are able to utilize that during that time period where it's locked in for that 2 years.
Sure. Yep.
Yeah. Mm-hmm. I mean, that's how banks and things make money, is they want you to invest with them and keep your money with them.
Yeah. And it's certainly, again, but they're not doing that to then affect a market stance, right? They're doing it. They're going to offset those risk. A lot of people, that's what their worry is that, oh, they're betting the other side of this. And it just is not the case.
Yeah.
Okay, well, onward and upward. We don't want to run out of time here, Jeremy.
Sure.
I got a couple more for you.
Mm-hmm.
By the way, those are really good. That explanation of the Buffett, I have had a few others on with the Buffett. That was fantastic. That really kind of got right down to what it is. So I thank you for that.
Mm-hmm.
We have an election coming up. So by the time this airs, actually, the election is going to be already over. So
gotcha.
We're actually recording on Halloween. Happy Halloween, everyone. But it'll come live to our clients the Wednesday after the election. So I have to ask you, this is my number one question over the last 2 months. The election happens. How do markets behave? How do you guys see that shaping out? Or do you have an opinion on it?
Yeah. So here's the thing. When they're hearing this, they'll hopefully know it's decided. I think that's probably your biggest short-term risk, is that it is a highly contested election, right?
Right.
There is a potential that we don't know the results even immediately afterwards, and there's a potential that that could drag on for a bit. I think that would probably be a worry for the markets.
Okay.
I think that would be your most negative scenario, if you will, because here's my opinion on this, is that, markets will react, but markets react to sentiment in the short term. They react to earnings growth and fundamental nature of business in the long term. And so we will try to understand, once that has been decided, and hopefully it's decided night of, hopefully we don't have an extended period of uncertainty there, who benefits, who's hurt. I mean, and that's the kinds of things that we're going to do, is analyze that, right? We're going to pay attention to, what do we see? What do we see that actually has a chance of passing? That's what we're always going to be much more attuned to, is what actually has a chance of getting through.
Okay.
Because there's, everything in October is rhetoric, right?
Yeah,
I mean, the
for sure.
noise is
Well, you're coming to the
unbelievable.
finish line. Everyone wants to just throw.
And they're promising
thing.
whatever.
Yeah, for
Here's what
sure.
I'm going to do. Most of that is noise, right? Most
Right.
of that will not actually occur.
Mm.
So we have to understand what actually has a potential of occurring and who benefits and who's hurt. That's analysis. That is not prediction. That is not prognostication. That's what the work we're going to do right after the election happens, and if there's a decided party that wins. So from that perspective, that's what our expectation for us to do. We're not going to react aggressively. This person wants, so we're going to do this. This person wants, so we're going to do that.
Right.
Nope. This person wants, let's figure out what we're going to do. And I think that's what most market long-term participants are going to do. In the short term, it's all a sentiment related game. So from that side, in the next month and a half, I would expect greater volatility. There's no question about that. I think that, we have had a very, very, very strong market. Don't get me wrong. I mean, 2023 was a 20% plus year. 2024 has been a 20% plus year thus far. That is a very strong. I think to expect that in the future is probably a little optimistic, but there's nothing, the economy doesn't fall apart the day after an election, right? The economy kind of continues to do
And
what
Chipotle doesn't shut down, and McDonald's doesn't shut down.
Most people are going to go to a restaurant the next day. Most people are going to go back to work the next day. They're going to do what they do. And as long as those things, whether it's jobs, whether it's employment, whether it's consumer spending, those are the kinds of things we're going to pay a ton more attention to than anything that is Washington focused, if you will. So from our side, again, expect it to be choppy, expect it to bounce around a little bit. But really, again, what we invest in here is U.S. based businesses. And my simple opinion is they're among the best and most efficient and adaptable in the world. And there's a simple reason for that is if they're not, they're going to go out of business because somebody's going to take their business, right? So from that side, that's what we're going to pay a lot more of attention to. We'll analyze, we'll monitor, we'll communicate what we see as opportunities and also things that we maybe are a little bit more worried about. But that's something we're going to do after the fact. We don't get into the prediction and especially portfolio positioning based upon those predictions. We think that's a losing proposition.
And I think for everyone listening out there, you don't want your portfolio managers, your asset managers making knee-jerk reactions the day after an election. I think
I would hope not.
Yeah, that's got to be the biggest takeaway. I'm pretty methodical, and I'm glad that you guys are too, because we don't want anything like that. I'll ask you one more question, Jeremy. We're in this interest rate cutting cycle. You kind of alluded to it earlier with the G50. Obviously, getting its legs underneath and doing quite well. What does that mean for the markets going forward? Because they're going to be cutting rates. Probably for the next year or two at some level, whatever that level looks like.
Yeah. I always say interest, good or bad. People ask me that interest rates, good or bad. And I would say it depends on who you are, right? Because it's the saver versus spender, right? So the saver will probably benefit, as rates come down, as we talked about before, as interest rates come down, bond prices go up.
Right.
That's good in the shorter to intermediate term, right? If you're a bond holder, you're probably going to make a little bit more money from that kind of happening. But here's the thing, the market anticipates rate cuts, right? To a certain extent. And sometimes they overshoot, sometimes they undershoot what those expectations are. So a lot of times rate moves different, the actual interest rates move differently than what the Fed actually does. The short-term rates move almost exactly with what the Fed is going to do. Long-term rates move much more on what we feel about the economy and what we feel they're going to do in the future. So from that side, again, the biggest surprise I can give people now is saying, the last cut when they did 50 basis points, the 10-year treasury rate right now is higher than it was when they did that. So you can't take that as, they're going to go down in the exact same way in the entire time. The market is trying to anticipate what they're going to do, and they'll position as a result. So from our side, what we say is that, hey, bonds are probably okay at this point right now. They were a better deal a year ago, to be honest with you, because rates are going to come down. You'll reset rates when you're buying new bonds will be at lower yields. So you probably get a lower coupon. Your payment won't be quite as good. Think 4, 5, 6%, which again, for bonds, not the worst case scenario in the world, right? We'll take that all day.
It's a holding spot, really.
Yeah, exactly. I mean, that's a sweet spot because you don't want to be chasing big returns in your bonds because you have to take a bunch of risk to get there. That's not what your bonds are for, right? Your bonds are for giving you recurring income and then also lowering the volatility of your portfolio. That's what you should be doing there. From a stock market side, again, what I always caution people on is don't assume that rate declines are 100% positive for the markets. And here's why I would say that is if they're cutting faster than we expected, well, why are they doing that?
Right.
Chances are they're doing it because economic trends are getting worse, right? And economic trends getting worse is not usually very good for stocks. So it really depends on the pace. If they're pacing it slowly and saying, hey, inflation's under control, the economy's still good, we can lower interest rates, but we don't have to be aggressive about it, and we can kind of be methodical and move our way down slowly, I think that's actually the good case scenario for stocks over longer periods of time. If they start to pivot and we start to hear, well, we're starting to see worsening job environment, and there's some things we're starting to get worried about, so we're cutting at 50 basis points, or we're cutting more aggressively than people anticipate, that's actually probably more of a negative for the stock market.
Right.
Our base case assumption is that they can be methodical because the economy right now is pretty darn good.
Right.
There's nothing that would suggest to us that we see right now that there's recession on the horizon or anything like that. Jobs are at 4.1% unemployment, which is, it's not the 50-year lows that we had a year and a half ago.
Still pretty
long-term,
low.
long-term average is 5%. So we're still below that. So jobs are good. And when jobs are good, people are going to continue to spend money. So we think the economic backdrop is still pretty healthy for the market overall. So that usually portends to higher going forward. But just be aware that we have had a very, very strong rally. What I've been telling people very simply is bring an umbrella. And bring an umbrella doesn't mean it's going to rain outside. It means you have something that in case it does. And a lot of the stuff we talked about earlier does that. Bonds do that. Fixed index annuities do that. Buffered index does that. Have a component of protection. Don't sell everything because we still frankly think that things are going to be pretty good. We just want to be prepared in case it's not.
Right. Perfect. Well, hey, Jeremy, we could keep on keeping on, but I want to thank you slicing some time out, coming down here. Tony, I'm sure you enjoyed it too. You got Jeremy right in that studio, that brand new studio you guys got. So that's
great information.
Yeah. Great information. We'll have you on again, Jeremy. These are great insights, and just want to thank you. Thanks for
Love it, sir. Appreciate the time.
No
All
problem.
right. And just let's remind listeners and viewers really quick, if they want to give you a call, Rob, set up a consultation, have questions, that number is 630-780-1099. That's 630-780-1099. Or they can go to the apadvisorsgroup.com. That's apadvisorsgroup.com.
Fantastic.
All right. And that does it for today's episode of Ready, Aim, Retire.